Okay. All right, guys. I am going to talk to you about the different valuation approaches that we've been doing. I'm going to reconstruct the table in which I'm going to show you what are the different valuation approaches. We talked about the WAC approach to valuation. This is the standard approach that we've been using, but then I said that you can also use a couple of different approaches to go about valuation exercise. There's the flow to equity approach, there's the capital cash flows approach, and there's the adjusted present value approach. All of these are very important, especially the flow to equity approach and the APV approach. So after showing you how these approaches differ from each other, once again, which is what I did towards the end of the class, I'm going to try and do two examples with you today. One is the Tex-Mex example, which is on the PowerPoint slides. And the other is the Sampa video case. I'm hoping at least some of you have read the case, and at least some of you have tried to attempt it as well. If you've not, we're going to go over that today, and it's a very important case in the sense that there's some practical stuff over there that you'll learn in terms of how to implement these approaches. So again, towards the end of last class, I basically said that you have, if I were to draw a table which basically tells you what are the different approaches, right? So if I am measuring approaches here, so I have approaches, and then I'm measuring over here. How do you measure cash flows? And how do you measure the discount rate? Right, so discount rate. Then basically what we're saying is that, look, the first approach is the WAC approach to valuation. And the WAC approach to valuation basically says that the way you need to measure your cash flows is by calculating financial cash flows, where we know that financial cash flows are equal to EBIT into 1 minus tax rate plus depreciation minus CapEx minus changes in net working capital. Right? So this we already know from all the discussion that we've done around financial cash flows. Financial cash flows are also called unlevered cash flows because these cash flows are calculated as if the firm has no leverage. However, in order to account for the effect of leverage, then the discount rate that we use is called the WAC. So WAC is our way of accounting for any effect of leverage. So again, to remind you, WAC is calculated as B over, call it value of assets, where V is basically the sum of B plus S. So you do this times RB into 1 minus T plus S over V into cost of equity. Right? So again, the idea here is that you're accounting for both the cost of debt and the cost of equity, and any tax benefit that you get from the interest tax shields, that is accounted by this 1 minus T over here. So this we know and love. We then said that, the other approaches to valuation are, so the other one is flow to equity, and the flow to equity approach to valuation basically says that you don't look at all the financial cash flows. You basically take financial cash flows, but subtract from that what is going to the bondholder. So subtract the after-tax interest expense, and then account for any net new borrowing. So this is how cash flows are measured. This is purely from the equity holder's perspective, because you're taking all the unlevered financial cash flows, you're accounting for the tax shield that you get on the interest expense, and then saying, okay, this is what I'm paying to the bondholders, and you're adding net new borrowing. In other words, if you're going to be borrowing money, this is going to represent an inflow coming to the equity holders. Conversely, if you're going to be paying off the principal, the net new borrowing is going to be a negative number, and therefore that is also going to represent an outflow from equity holders' perspective. So this is how you measure flow to equity, and because this is the equity holders' perspective, the discount rate that you want to use to discount these cash flows is the cost of equity only, right? It's the same RS, cost of equity, right? So the measure of cash flows and the measure of discount rate go hand in hand. Okay, so this is the flow to equity approach. The third approach that we talked about was the capital cash flows approach. And the capital cash flows approach basically said that, look, I'm very similar to the financial cash flow approach or the WACC approach in the sense that we are still looking at what are the cash flows that are available both for bond holders and equity holders. Like, so it's not just the equity holders perspective, it's both bond holders and stockholders. However, while these are unlevered, I want to account for the effect of leverage and the tax shields here. So over here, you say, I want to add to this the added amount that we have because of the interest tax shield. So T times interest expense, this is basically your tax shields. Now, because you are accounting for your tax shields in your measure of cash flows here, then the discount rate that you use over here is simply B over V into RB plus S over V into cost of equity. In other words, you don't have 1 minus T appearing over here anymore because the tax shield effect is already captured in your cash flow measure, right? So again, consistent. Cash flows must be consistent with the discount rate. So again, this was last time. And then finally, we said there is something called the APV approach. And the APV approach says that you take your unlevered or financial cash flows. So you start from that. And you also then discount these at R naught, where R naught is your cost of unlevered equity. So in other words, you take your unlevered cash flows, you discount them at your unlevered cost of equity. By definition, when you will use these two for your valuation, you're basically saying there is no leverage, there is no debt. Our cash flows have no effect of leverage. Our discount rate has effect of no leverage. So this is literally as if you're saying the firm is unlevered. So the value of the firm or the project that is going to come about is going to be VU, which is value of the unlevered firm or the unlevered project. But then how do you account for tax benefits or costs? You add or subtract them separately. So plus minus tax, your financing effects. Like any present value of any interest tax shield and all of that, all of that is added or subtracted separately. So this approach is kind of different from all the other approaches because you're doing it in parts. You're doing value of the unlevered firm or the unlevered project first, and then you're accounting for all costs and benefits of financing separately. So that's why this approach to valuation is known as valuation by parts. Okay? In the DuPont case, you will primarily be working with this, the APV approach primarily, and you will also get to implement this and sort of see how they work together. Okay, so again, capital cash flows is not as important, but flow to equity and APV are. So what I want to do today, and I want to make this very clear, the purpose of today's lecture is to show you how, when implemented properly, all these valuation approaches will lead you to the same result and the same conclusion. All right, let me say that again. If you are trying to determine the NPV of a project, whether you do it using the WACC approach or the flow to equity approach or the capital cash flows approach or the APV approach, you will arrive at the same answer. It's just a matter of convenience, which approach should be used when. So the purpose of today's lecture is not to say, oh, here you should use APV and here you should use flow to equity. The purpose of today's lecture is to show you how all of these are, in the end, consistent with each other. It's just different ways of doing the same thing. And then later on, we'll decide which approach applies, when. So that's kind of the idea. So with that background, before I move on, is there any question about this table? This is a very important table for you to sort of understand how these valuation approaches sort of are linked together. Notice that in the cash flow measure, you're basically, financial cash flows is the main ingredient and then everything else is sort of driven by it. Yes, Vic.
How do you get rho? Explain that.
Oh, R naught. Okay, so this R naught, this you can get basically R naught is your cost of unlevered equity. So maybe I'll use a different color. So this is the cost of equity. So how do you get cost of equity? Cost of equity in general is calculated as the risk-free rate plus beta times the market risk premium, isn't it? That's how you get cost of equity. This is the general formula. When the firm has no leverage, then the beta that will exist will be the asset beta of the firm. So when you have asset beta or the unlevered beta, when you'll plug that into CAPM, that combine that with the risk-free rate and the market risk premium, the cost of equity that will come about will precisely be R naught, which is the cost of unlevered equity. So cost of unlevered equity is nothing but the cost of equity that comes about when you plug asset beta into CAPM, because that's the beta that will exist for equity at that stage. Are we okay here? Okay, so with that, take a look at this problem. So Tex-Mex is a company, it's considering, so it's a manufacturer of custom packaging products, and it is considering a new line of packaging, right? So this is a new project that it is about to embark upon. It's called the Meta Series. Now, we're not given a whole lot of details about what this new line of packaging does, but the Excel sheet, which I'll show you in a bit, it shows the projected financial cash flows of this project over its 4-year life. So this Excel sheet is actually posted on Canvas, and basically this is what it looks like. So I just want you to focus first on this sort of upper half of this Excel sheet, where basically you are told that so notice that this is a 4-year project. Very simple in the sense that at time period 0, which is today, you obviously have no sales, no COGS, no profits. You do have some operating expenses, maybe like marketing expenses or whatnot. So this would be tax deductible. You have no depreciation here. So earnings before interest and taxes today is -7. However, for the next 4 years, you are expecting sales of maybe like 60,000. So imagine these numbers being in thousands. So this would be 60,000, COGS of 25,000. So that means gross profit, which is the difference between the two, right? It's just this. Let's suppose that operating expenses, this information is given to you, right? So I've already highlighted the information that is given. So then the depreciation, it turns out, is also given. And so you can calculate EBIT as whatever is your gross profit minus your operating expenses and your depreciation. So this gives you your earnings before interest and taxes. Are you with me so far? Nothing fancy up until now. It's just sales minus COGS minus other expenses minus depreciation to get to EBIT. And then let's suppose that tax rate is 40%. Let's suppose. Okay. So then I'm applying a tax rate of 40% to my EBIT to get my unlevered net income. This is basically EBIT. Maybe I should write this as EBIT into 1 minus the tax rate. Basically, that's what it is. This is what is left behind after I have deducted my taxes. We know that in order to get to financial cash flows, I need to add back depreciation. Depreciation was already given over here, so I'm just adding these back. Now, CapEx, this number is also given to you. Let's suppose $24,000 is the amount that you need to spend on this machinery. So $24,000 is your CapEx, and this is why you have depreciation of like six every year as well. My main point is that getting to financial cash flows is basically taking your unlevered net income, adding depreciation, subtracting CapEx, subtracting any changes in net working capital, which is basically the very definition of financial cash flows. So I hope that you don't have any particular problems following this math to arrive at the financial cash flow. So when I say the financial cash flows for this project are shown, this is basically what I mean. Are you comfortable with this? Any questions on any of this? Because I'm really building on this. So if you're kind of lost over here, please ask me. Okay. Okay. All right. There's some additional information that is given to you. So you are also told that TexMex's current debt to equity ratio, let's suppose it's 1. So this is the debt to equity ratio right now. This is 1. Not the debt ratio, debt to equity ratio. So B over S, not B over V. Okay, this is the debt to equity ratio. You are further told that cost of equity for TexMex right now is 10%. So this is what equity holders want right now. That's 10%. And cost of debt is 6%. Okay, this information is given. Further, suppose that TexMex intends to finance the Meta Series project in a way so that the firm's debt to equity ratio of 1 is going to be maintained. What I mean by that is this. Without having undertaken the project, right now the debt to equity ratio is 1. Yes? That's given. What I'm trying to say over here is that once the firm is actually going to, sorry, wrong Excel file. Once the firm is actually going to spend some money on this machinery, like $24,000, it's going to require some financing for this, right? It's either going to fund it with equity or with debt, right? But funding with debt or equity, this expenditure is going to change the debt to equity ratio. What I'm trying to say over here is that the firm wants to fund this new project in such a way that going forward, its debt to equity ratio remains at 1, right? So it doesn't want to change its debt to equity ratio. So that's basically what I mean. If the debt to equity ratio is 1, then what is the debt ratio? If debt to equity ratio is 1, 0.5, yeah, right? So debt to value ratio, B over V, basically this is 0.5, just making sure. Okay, so this is the situation. Here's what I'm asking you to do. I want you to first figure out whether this is a worthwhile investment or not. If you had to do this, what would you do? Like, what would be your line of attack? Right? Is this a worthwhile investment or not? The standard way in which you would approach this would be like if all of this information is here, what would you do after this?
Net present value. Okay,
net present value. You might say, let's calculate the net present value of this project. You have the financial cash flow, so that's great. What's the other thing that you need? So discount rate, right? And the WACC approach to valuation will say, well, figure out the weighted average cost of capital. Fortunately, you have information on that as well, because if you actually take a look, your cost of debt is given, right? Your cost of debt is given at 6%. Your cost of equity is given at 10%. And more importantly, perhaps, as the firm is going forward with the project, its debt to equity ratio is not going to change. So its cost of equity will remain at 10%. So you'll calculate the WACC. And if you actually go about calculating the WACC, you'll find that this will come out to 6.8%. How? Basically, this is 0.5, which is the debt ratio, into the cost of debt, which is 6%. But you do have to multiply it by 1 minus the tax rate, which is 1 minus 0.40. Right? So the tax rate is given. And then the remainder 50% is going to get multiplied by the cost of equity of 10%. So if you're going to do this, get the 6.8%, you're done. And so once that's done, then you can figure out the value. I'll do two things, and you'll see why this is important. I am first calculating the value of the, VL stands for the value of the levered project. Value of the levered project. This is not net present value. This is simply the present value of the project's cash flows after the initial investment. Right? So to show you, basically, over here, if I say what is value of the project, and so this is what I'm calling VL. Right? So this is equal to, I'll do equal to NPV, equal to NPV. The discount rate is 0.068, which is my WACC. And then I am only discounting This guy, just the inflows. The worth of the project without the initial investment, this is 61. Well, if you make this to correct to 2 decimal places, this is 61.25. And if you calculate the net present value, naturally this will be equal to the 61.25, but then you'll add the initial investment of 28. So and again, I'll format this to say that this is 33.24. So positive NPV investment. Again, nothing new up until now, right? Just standard WACC valuation approach. So far, so good. What I want to do now is to show you how you would have approached this exercise through other approaches and still gotten the same result. So the next approach that I want to highlight is the APV approach, the adjusted present value approach. What is the adjusted present value approach to this problem? What would you be doing differently? If we had to do the exact same thing using the adjusted present value approach, what would you be doing differently? Benjamin?
Would you calculate like you discount cash flows as if it was all equity?
As if it was all equity, which means that even though your financial cash flows will remain the same, right? Because these are unlevered cash flows, you would not discount those cash flows at the WACC. Rather, you would need to know what is the cost of unlevered equity. Right now, the required rate of return from the equity holders, that is 10% over here. But the reason that's 10% is because right now the firm is half debt, half equity, right? So you actually need to first know what is the cost of unlevered equity or the rate of return that equity holders would want if there were no debt. How can you go about that exercise? Is there some formula that you can use which can help you arrive at that? Unfortunately, there is no information given on betas over here. Otherwise, you'd say, hey, if I knew the equity beta, I could just unlever it, and that would give me my cost of, like my unlevered beta, and then I'd plug it back into CAPM. Right? So you are not given any information on betas. Is there something else that you can do, however? Modigliani and Miller, anybody remember? Chad?
This doesn't really make sense, but I guess you could assume it's the cost of debt rate.
Sorry?
I guess you could assume it's the cost of debt rate.
No, actually, you should never do that. The reason is that debt is, in the hierarchy, debt is always less risky than equity. Think about it, right? Debt holders have claim to cash flows first. Even if the firm had no debt, right? The fact is that equity holders are always exposed to the business risk at least. So that risk will always be more than a risk-free cash flow or less risky cash flow. So don't assume 6%. However, if you recall, Modigliani and Miller basically said that if the firm is looking to maintain the same debt ratio, then RS equals R naught plus B over S into R naught minus RB. This was basically Modigliani and Miller proposition number 2. Notice that I haven't included any 1 minus T term over here because this formula only applies when the firm is trying to maintain the same debt to equity ratio, which is the case over here. Tex-Mex is trying to maintain the same debt to equity ratio. And so for that reason, we don't need to, even though tax rate is positive, we don't need to account for 1 minus T in this formula. This guy is saying that RS is equal to the cost of unlevered equity. This is at least the rate of return that equity holders would want, even when there is no leverage. And then if there is leverage, they will need this extra premium. Fortunately, we have some numbers to plug in here. We know that right now the equity holders want 10%. we are trying to figure out R naught. We know that right now the equity holders want 10% because this guy, the debt to equity ratio right now is 1. And we are trying to figure out R naught, and the cost of debt is given as 6%. And so if you'll actually solve for R naught over here, you'll find out that this will solve out to 8%, and that is your cost of unlevered equity. Now you can try and solve this. Basically, this will become R naught plus R naught, so 2 R naught, and then 6% will go on this side to become 16. So 16 divided by 2 is going to be 8. Yes.
I know that's the same value of like the WACC without the tax shield.
Yes, that's not a coincidence actually.
Okay.
That's not a coincidence. So this is actually, so it's a good observation. You'll notice that 8% is smack in the middle of 6 and 10. So it's literally as 50% of 6 plus 50% of 10, which is like the WACC without tax. That's not a coincidence because you might recall that in Modigliani and Miller world, the WACC basically starts out from R naught, right? So this is when you have no leverage, and then as the firm is taking on more and more debt, WACC falls because of the interest tax shield. At this point, you're basically at this point, this R naught, and this is as if you are basically calculating WACC without taxes, because all the declining effect on WACC later on is because of taxes. So it's not a coincidence. Actually.
So it's always going to be the weighted average without the tax shield.
That is correct. That is correct. And in fact, I'm glad you brought that up, because if you actually notice, this by definition is also going to be the discount rate that you would end up using in your capital cash flow approach, because in the capital cash flow approach, the tax shield is accounted in your cash flow measure, and so therefore you end up calculating WACC as if there is no taxes, which by definition is then also going to be this. So it's the same thing. That's right. But anyway, I don't want to jump ahead. The main point was to help you figure out what is the unlevered cost of equity. Not surprisingly, equity holders will want something less than 10% because there's no debt, but they will want something more than 6%, which is what the debt holders want, and equity is going to be riskier. Okay, so if you were actually doing this on Excel, then you would say the value of unlevered project, right? So I'm going to get rid of this. And by the way, don't worry, I have all the stuff laid out below this as well, but I'm just trying to show you. Value of the unlevered project would basically be, you do the NPV, right? You take your financial cash flows, these financial cash flows, and, and the rate at which you're going to discount them would be 0.08. 0.08, which is the cost of unlevered equity. So you have cost of unlevered equity discounted at, and you just use that as the discount rate for unlevered cash flows. So if the project was completely unlevered, then this is what it would be worth. And therefore net present value would be equal to this guy plus this guy. Now, you of course don't get the same answer. In fact, this shows that the project is a little bit less valuable, right? Previously you had 33.64 over here, but now you have 31.62. So basically the project is going to be less valuable if you did not fund it with any debt at all. And it makes sense because debt offers that interest tax shields. But that's the problem, right? The APV approach is still not done, because all that you've done is figure out what the firm would be worth or what the project would be worth when there was no leverage. But then the APV approach says what? Don't stop here. Any benefits that you get from financing, like the interest tax shields, you should add them separately. So what do you need to do then? What do you do from this point on? If you already know what the project would be worth in the absence of any leverage, if you wanted to find out how much extra value would be created if the firm had debt, what would you need to do? Yes?
Present value of tax shield.
Yes, so you need to figure out the tax shields and then calculate the present value. Absolutely. Now, in order to calculate the tax shields, very good, right? So in order to get the tax shields, what do you need to do? You basically need to figure out, so interest tax shields, ITS, is basically the tax rate times the interest expense. And we know that interest expense in turn is going to be whatever your cost of debt is multiplied by the debt level. So if you can figure out your interest tax shield in year 1, 2, 3, and 4, you can multiply that. You can basically figure out the present value of that and you'd be done. You'd add that back. Right? So this is what you need to do. Figure out the interest tax shields and then calculate the present value. Fortunately, the cost of debt is given to you. So this guy is given, this is 6%, tax rate is given 40%. What about the debt level? What about the debt level? This is the tricky part. This is the tricky part. Why? Because the firm has, this is very, very important. Please pay very close attention, okay? The reason why this is the tricky part is because the firm is targeting a constant debt ratio or a debt to equity ratio. And as the firm will, as the project's value will change, the debt will need to adjust. The level of debt will need to adjust so that the debt to equity ratio remains at 1. So let me show you what I mean by that. If you actually go to the Excel sheet, sorry, wrong one, right? So notice what I'm doing over here. Ignore this for the time being, okay? Ignore this for the time being. What I'm saying is this. If you look at the value of the project, if you look at the value of this project, when you calculated the value using WACC, the worth of this project is 61.25. This is the value of the cash inflows. If the firm wants to keep its debt to equity ratio at 1, this means that the level of debt that needs to exist here for this project has to be half of this value. So I'm calculating the debt level that is implied by this value, so which is 50% of this, right? In other words, I am trying to deduce the level of debt which is implied by a debt to equity ratio of 1 or a debt ratio of 50%. Right? I'm trying to deduce that. Here's yet another way of saying it. If you know that you're about to invest in a project which will bring in $61.25 worth of value, right? If you don't change your debt level, your indebtedness will go down. But you don't want that. You want it to be at the same level. So in order to fund this project, then you will take on about half of that value's worth of debt. And that is basically what I'm suggesting. So basically, this means that the firm will need to take on debt of about 30.62 here. So this will need to be the level of debt here. And then let's move on from this year to next year. So this is again very important. I'm saying, okay, let's suppose 1 year has gone by, right? 1 year has gone by. So this, I've already received the first 18 over here. Now, how many cash flows remain? This 18, this 18, this 18, right? What is the worth of these next 3 18s at this point? So I'm calculating that. So the present value of these 18s now is obviously lower. That's 47.41. And therefore, I'm deducing the debt level that needs to be consistent with this by doing, okay, so what is 50% of that? So next year, my debt will need to reduce to 23.71. And then 30, this, I deduce the value next year, which is again, discounting these future cash flows at 6.8%, which was my WACC. And then I say, okay, if this is the value that my project is going to be bringing in this year, then this is 50% of that. That is the level of debt that needs to exist. And finally going here, and then 50% of that. My main point is this. Right? Since your debt to equity ratio is being maintained, your debt level will need to change in order to maintain that ratio. So I'm deducing those debt levels. And why am I doing that? Because once I know the debt levels, I can figure out my interest expenses And if I can figure out my interest expenses, I can figure out the interest tax shields. So that's what I'm going with next. Yes.
So would that be like paying off the principal? And
Exactly.
the overall debt?
Exactly.
So you
Exactly.
just
So you
structure.
take on more debt and you pay it off. Yep, that's exactly what it is.
So you just take like half of the 18 million cash flows, and like so 9 million, it pays that off, or
No, so paying off over here is the difference between this 30.62 and 23.71.
Okay.
You took on this much debt. Next year it needs to reduce to 23.71. So you're paying off the difference between these two numbers. That's what's happening. That's paying off. So now I'm calculating interest expense. Now again, please note that the interest expense is 1 year ahead. So basically, this is going to be my outstanding debt today. So my interest expense is based off of that, but for next year, right? So this is again consistent with what you've seen before, that interest expense is sort of based off the debt outstanding in the previous time period. So I'm calculating this interest expense. So basically, if I took on $30.62 worth of debt today, then by the end of the 1 full year, the interest expense that I will owe will be 6% of that debt level. So interest expense in the first year is going to be this much. Interest expense in the second year is going to be this much. Third year is going to be this much, and fourth year is going to be this much. So these are my interest expenses for the 4 years of the project. And then I'm calculating the tax shield by simply multiplying my interest expense by the present value, by interest expense by the tax rate. So this now tells me how much interest tax shields I'm getting here. And my objective here then is to figure out the present value of the interest tax shields. And so this is what I'm doing over here. Now, again, this is again very, very important. Yes?
Well, I was gonna say, where is it that 8% you're discounting at the equity?
Yes. So that's precisely the point that I was going to make. Why is it that I am discounting my tax shields? Very, very important. Okay. Why is it that I am discounting my interest tax shields at 8%, which is my cost of unlevered equity? Because you might recall, this is extremely important, you might recall that when we were in the Modigliani and Miller world, this is not quite what we had done. In the Modigliani and Miller world, we had calculated interest tax shields as T times RB times B. And we said we get the same tax shield in year 1, year 2, so on and so forth. So we said when we're calculating the present value, we treated this as a perpetuity, and we did T times RB times B, but then the discount rate we used there was RB, which was the cost of debt. It is there that these two canceled out, and we said, oh, the present value is T times B. Right? So when we were doing the Modigliani and Miller proposition, there the discount rate we used to discount the interest tax shields was the cost of debt, which was RB. I'm not doing that here. Rather, the discount rate that I'm using is the 8%, right? Not the 6%, which is the cost of debt, but the 8%, which is my cost of unlevered equity. Why? Why am I doing that? And this again goes back to this point that I was making in the last lecture. The main difference is, what is the main difference between what we're doing here and what Modigliani and Miller were assuming? Yes, Benjamin?
I was going to say something else. I was going to say, is it just like simply because we're doing it in parts? Like, isn't that a benefit?
That's not the main reason, actually, no. So that's a good guess, right? You're saying we're doing valuation by parts. And so since we did the valuation of the unlevered firm using 8%, now we just take the same 8% and do the other part of it, right? I see what you're saying, but that's not the reason. That's not the reason. In fact, we will see cases where we will not do that. We will see cases where the value of the unlevered firm would be calculated at the cost of unlevered equity, but then the interest tax shields will be discounted at the cost of debt. So this is very, very important. Okay, I want you to understand this. Okay, this is extremely important. When we break up our cash flows into different parts, we're saying some cash flows are coming from the project, some from the interest tax shields and all of that. Every cash flow needs to be discounted at its appropriate discount rate. If some cash flows are more risky than the others, then they need to be discounted at a higher rate. So just because we're breaking them up is not a sufficient condition to use the same discount rate. So by using 8% over here, basically then what is it that I'm saying? I'm essentially saying that my tax shields are as risky as my underlying business when it were not unlevered. That's basically what I'm saying, right? And why is it I'm saying that?
Because you're targeting a debt ratio.
Exactly, because you're targeting a debt ratio. And when you're targeting a debt ratio, then going forward, your debt is changing, your debt level is changing. It's riskier than knowing a flat level of debt. It's a little bit riskier. That level of debt in turn is a function of the underlying value, which is a function of the underlying business risk. So main point is that tax shields are as risky as the underlying business. So this again, I want you to remember this, and this is again something that I'd written down, but I want to say write that down again.
Could you explain that a little further?
Yes. So first, let me write down write this down. Where did my whenever so maybe a different color. Whenever debt levels known means that interest tax shields should be discounted at cost of debt when debt levels are known. However, when debt ratio is known, then the interest tax shields need to be discounted at the unlevered cost of equity or are not. This is the main difference. Whenever debt levels are known in advance, the appropriate cost of debt is RB, or the appropriate discount rate for interest tax shields is RB. Otherwise, if the debt ratio is known, then the appropriate rate is R naught. And again, the main point is this, Blake. Yep. Since the firm is trying to maintain a certain debt value ratio, its level of debt will be a function of how the value is expected to be next year. And because that value in turn is a function of the underlying risk. Let me give you an example. Let's suppose you have a house, right? And you buy a house, and next you are saying, you know what, I always want to be 80%. Like I always want my loan to value ratio to be 80%. I always want to be 80% indebted. Okay. If the value of your house goes up, you're like, hey, my equity has gone up, my debt value has gone down, so I want to increase my level of debt. And likewise, if the value drops, then you're like, okay, I want to pay it off because I don't want to be overly indebted, so you again dropped it. But your level of debt is going up and down depending on how the house value is going up and down. And that in turn is going up and down because of the riskiness of the house. So you never know with certainty how much you're going to save in taxes because of the interest expense, because your debt level is risky. That is different from when debt levels are known in advance. When you already know that I want to have this much debt this year, this much debt this year, then this much debt this year. So that's why the two different discount rates. Okay.
It's like the cash flows aren't known, so you can't know the
exact. Exactly. Which is precisely why the discount rate for interest tax shields here is RB, which is going to be lower than R naught because here the risk is less, here the risk is more. Right. So again, it sort of follows through. So with that, I wanted to spend some time here because this logic will continue later on as well. So now notice what I'm doing. All that I'm doing then is calculating the present value of the interest tax shields here. So this tells me that the interest tax shields are worth 1.63. Do Do you remember when I said calculate value of the unlevered project, what did we do? We did equal to NPV. We did equal to NPV. The unlevered or the cost of unlevered equity was 0.08. So we did that, and then we discounted all of this. Right? I'm saying that the value of the levered project, VL, using the APV approach is basically the value of the unlevered firm or the unlevered project plus the present value of all the interest tax shields. This is 61.25. You see? This is exactly the 61.25 that you got from valuing the project at WACC with just the financial cash flows. Main point, the valuation of the cash flows, the free cash flows that comes about when you discounted these at the WACC is the same as if you first do the unlevered and then add the tax shield separately. You get the exact same answer, and therefore the NPV is going to be the same as well. Right? So this 61.25 using discount rate of 6.8% is exactly equal to the 61.25 that you're getting by first determining the value of the project unlevered and then adding the tax shields separately. And that was kind of my point. The two approaches are consistent with each other as long as you know what are the appropriate rates to discount the cash flows at. So the NPV is going to come out the same as well. Any questions on this? Are you comfortable with WACC approach and APV approach being consistent with each other? This will require some practice, needless to say. And so sample video case will also provide practice. The DuPont case will provide practice. And the ISS case will provide some really good practice. It's advanced, but it'll certainly provide practice. Okay, so these are the two approaches. The third approach is the cash flow to equity valuation approach, or the flow to equity, if you want to call it. So flow to equity, if you want to call it. You might recall that the flow to equity basically starts out by saying, let's just jot down the financial cash flows. So fortunately, you have those. These are basically what you calculate. Let me actually zoom out. Right, so you already have those over here. So I just copied that entire cell. But then it says subtract interest into 1 minus the tax rate. Well, that's a no-brainer in the sense that you already have calculated interest expense here in this approach over here. So you know what your interest expenses are in years 1, 2, 3, and 4. So all that I'm asking you to do is just multiply those interest expenses with 1 minus the tax rate and get this row over here. So you do that. And then perhaps the more important part is plus net borrowing. So this is important. Plus net borrowing. Notice that when you were starting this project, you were issuing debt. You were getting 30.62 more debt because this was consistent with you maintaining the debt to value ratio at 0.5. So this is how much extra money you are quote unquote borrowing. Yes? So this 30.62 is money coming in. So that is why the borrowing of 30.62 is being added over here. Right? So this 30.62 is the additional borrowing that you're doing at this stage. But then what happens next year? Next year, your debt level is 23.71, which means that you're paying off about $6 worth of debt next year. So there is no borrowing next year. In fact, if you look at the change in debt, that actually shows you that your net new borrowing is negative, or basically you are paying off debt. So this negative 6.92 is the difference between these two numbers over here. So this is you paying off debt. And then by the same token, this is how much you're paying off debt in the next year. This is how much you're paying off debt in the next year. And then finally, this is how much debt you've paid off in the next year, right? When the project is going to wrap up. Right? The project is finished. There is no more cash flow, so there is no more debt associated with this. So you pay off the entire thing, right? So this is what the borrowing and the paying off of debt is going to look like for this? Are you comfortable with this? Any questions? Basically, in order to invest in this project, you took on some debt, got a lot of value. Then as you keep on extracting some of that value, the value of future cash flows is declining. So you're reducing the level of debt accordingly until eventually you just wrap up the project and then you're like, I'm done. Okay. So that explains the borrowing and then paying off. And so now if you just implement the flow to equity approach, which is basically doing this minus this plus this, basically what you're getting is these equity cash flows. This is actually interesting. This is actually interesting because the flow to equity approach is actually suggesting that in the beginning when this project is going to be launched, notice what's happening. The capital expenditure that is required or the initial investment that is required in the beginning for this project is $28. Let's think of it in dollar terms. It's $28, right? This was or basically the amount of money that is required for you to spend over here, that's negative 28. But how much debt are you taking on at the beginning? In order to fund this project, how much debt are you taking on? 30.62. You are taking on more debt than is required to spend on this project in year zero. For that reason, in the beginning, not only is it that equity holders aren't putting in any of their money, rather they're actually getting money because you're taking on more debt than is required. And why are you doing that? Because this is a project that is creating much more value. You're trying to maintain the debt to value ratio at 1 here. So this might throw you off a little bit because typically you're used to seeing like a negative number in year zero. That's not happening here. Equity holders are getting some money in year zero and then in year 1, 2, 3, and 4 also. So that's a little bit different over here. Not typical, but consistent. Here's some troubling part potentially. If you say, okay, what is the value of equity? If you just calculate value, where value of equity is calculated as NPV, what is the rate that you will use? What is the discount rate that you should use? Cash flow to equity holders. What is the discount rate that you should use? Sorry? Cost of equity, which is given in our case as 10%, right? So 0.10, and then you just discount these future cash flows to equity. Now it turns out that if you will just do this, if you just do this part, this number is nowhere close to the 61.25 that you had gotten here. Right? This is just 30.62. So like what gives? I mean, when I was calculating value here, which was just discounting these 18s, I got 61.25. Here I'm discounting these cash flows at the 10%, only getting 30.62. How are the approaches consistent? What's the problem?
Wasn't that just maintaining the debt equity ratio?
Debt to equity ratio actually is being maintained here as well. You were capturing that by a constant WACC. The WACC was still 6.8%. So the same WACC, the fact that the WACC was constant here, the same 6.8% being used to discount all these cash flows, this is sort of capturing that you're using a constant debt to equity ratio of 1. So, I mean, that's still true. That part is still true. Did I see another raised hand? Yes.
I was going to say that like the cost of the debt or the value of the debt isn't necessarily relevant to the equity holders.
Yeah. I mean, the thing is that here the perspective was that of all financial cash flows that are available both to equity holders and debt holders, right? And so here the value was in terms of the value that is available for both debt holders and equity holders. Here we only have the equity holders perspective. So that's why the answer that if you are just interested in like what is the value to equity, you won't get the exact same answer. However, if you actually calculate the net present value, which is not just this guy, right? So notice that this guy was just the value of the inflows. If you take this guy and now do plus this 2.62, which is what the equity holders have quote unquote got to put in initially, which in this case is actually a positive number. This 33.24 is identical to the 33.24 we got when we calculated NPV here and NPV here. In terms of NPV, the answer is going to come out the same. Not in terms of value, but net present value. Again, the point that I'm trying to make over here is this. Okay? When you figured out the worth of these 18s over here as 61.25, this was the worth of all the financial cash flows. In order to get the NPV at that time, right, you had basically done equal to this guy, and then you had added this negative 28 to see what is the extra value that is going to be created. This came out 33.24. We're doing the same thing here. This is just the value to the equity holders, but then you're also subtracting, quote unquote, a smaller amount. So it's investment from equity holders perspective and inflows from equity holders perspective. The net answer is going to come out the same. That's the point. Okay. So it is in this sense that the approaches are consistent with each other. Whether you evaluate the project purely from equity holders perspective, what are the equity holders putting in and what are the equity holders getting? Or whether you are evaluating the project as what do I need to put in to get the cash flows for all capital providers, the net present value answer is going to come out the same if you do it right. That's the point. So that's basically what's happening over here. The NPV is the same. The capital cash flows approach is perhaps the easiest one to implement over here because the capital cash flows approach says, I mean, there are a couple of ways to do it. You take the cash flow to equity holders and you add to that the cash flow to debt holders, or maybe I'll show you the other way. So the capital cash flows approach, I think this is, you're probably used to seeing this. Capital cash flows approach basically says take the financial cash flows and then do T times interest, which is the tax shield, and add it together. Right? So if I take my financial cash flows, basically that's this. So I'll copy this and paste it all the way. So these are my financial cash flows. And then it says take the interest tax shields. So basically equal to 0.40 multiplied by, right? So that's the tax rate times the interest expense, which is right here. I've calculated this up above also. So I'll do Control C and then copy this. So these are my tax shields. Let me do this. And so these are my tax shields. Capital cash flow is basically the sum of these two numbers. So equal to this plus this. So you can now copy this and paste this. So my capital cash flows are basically going to look like these numbers, which is basically, I mean, this is an alternative way of doing it over here. I'm just showing you two different ways of calculating capital cash flows. The main point here is that now, if you will actually calculate the present value of these, so do NPV, what is the rate at which you're going to discount these? If you have calculated capital cash flows, what is the NPV? Or what is the discount rate that I should use for NPV here? If I've accounted for the effect of tax shields in my measure of cash flows, then can I use the WACC? Can't use the WACC because WACC already has the 1 minus T effect embedded in it. So what goes in here? This is the table. This is what I've calculated. This is how I'm calculating capital cash flows. The appropriate rate that goes with this is 50% of cost of debt and 50% of cost of equity, which is actually going to come out to 8%. So 50% of 6 and 50% of 8. And so if you actually go here and do 0.08 and then discount all of these, and then after this, add the initial investment, 33.24, which again is the net present value of the project. It doesn't matter how you do it, as long as the cash flow measure and the discount rate measure is consistent with each other. That's basically the purpose of this entire exercise, to show you how all the valuation approaches are consistent.
Was that one APV or capital?
This is capital cash flows. It's just two different ways of doing the capital. Here, the capital cash flow I'm calculating as flow to equity plus flow to debt holders. This is yet another way. It's basically, this definition is the same as this definition. It's just, I mean, if this throws you off, just use this, because this is basically what I've talked to you more about. Take the financial cash flows and add the interest tax sheet.
Is that the same thing in APV though?
No, no. APV says that don't add interest tax shield to your measure of cash flows. Don't add it to it. Rather, take the financial cash flows separately and value them separately, and then discount interest tax shields separately. Right? Yeah, I know what you mean. I know what you mean here, because over here, like in this case, because the discount rate for both is 8%, is sort of like both. Yeah, you're right. You're right. In this case, it's sort of happening, but that will not happen always, especially when debt levels are known. Yeah. Yeah, that's a good observation. Yeah. Yeah, in the APV approach, this was getting discounted at 8% separately, and this was getting discounted at 8% separately. And I see what you're saying. You're saying basically you're doing the same thing, just combining the two, but that's not always going to happen. I know, a little bit of information overdose, but I wanted you to know how to implement these approaches, because if you're not comfortable with this, then you will likely have trouble in the next couple of cases, at least. And so I want you to be comfortable with this. For that reason, I want to move ahead with the Sampa video case, at least start it off. Though, anybody read the case? What's going on in Sampa video? Nobody read it? Yes.
Aren't they trying to get into the DVD sales like Netflix?
Yeah. So they're about to embark on this new investment where they say, let's start delivering DVDs at home. And they basically, I mean, it's a very simple one page case, but it's not as much of a case as it's like an exercise. I had given you like very specific questions to look at. So basically, this investment, they've already figured out how much they can expect to sell DVDs by doing these delivering DVDs at home. So this information is given to you. They're expecting sales of 1,200, then 2,400, or basically these are all thousands of dollars. So these are like 1.2 million, 2.4 million, so on and so forth. They have some expectation about EBITDA, the EBIT, and then the capex that is required each year, and no investment in net working capital. So this is all the information that is given to you from this investment. Sorry, would you please? Now this is not to suggest that this is a finite project. Rather, the forecasts that are given to you are for the next 5 years. And what I had asked you to do is the following. I had given you the suggested analysis questions to figure out what is the value and net present value of this project if it is entirely equity financed. Then suppose Sampa Video assumes a fixed level of debt of $750,000 to invest in this project. Use the APV approach to determine the value and the net present value of the project. And then finally, suppose that Sampa Video, instead of assuming a fixed level of debt, assumes a debt ratio of 25% in market value terms. Determine the value and the net present value of this project using the WACC approach, the flow to equity approach, the capital cash flows approach, and the APB approach. Basically, I wanted you to practice all these different approaches. Okay. So what I'm going to do is actually start out on this. And the way I'm hoping that you can see that the way we've implemented these approaches in the Tex-Mex case, you should be able to see the flow of things here as well. So let's so again take a look at those of you who didn't look at the case. Basically, this is the forecast that was given for just the year 2000. This is where the firm is kind of today. And then in 2001, they're making this investment. They have some forecast for 2002, 3, 4, 5, and 6. And then finally, one other piece of information that is given to you is like, what is the risk-free rate? What is the cost of debt? What is the cost of equity? Market risk premium, asset beta, and all that. Okay, so tell me. Let's take a look at the first question that I posed, okay, which is perhaps the simplest one. What is the value and the net present value of the project if it is entirely equity financed? So basically what I'm asking is value of the unlevered project. If you're trying to determine the worth of a project as if it were completely unlevered, what would you do? What would be your line of attack? What are the two things that you would need? Benjamin?
Cash flows and the discount rate.
So the financial cash flow, well, so cash flows in the discount rate, but within cash flows, very specifically unlevered or financial cash flows. And within the discount rate, not just any discount rate, but the unlevered cost of equity, or the cost of equity that would exist in the absence of any leverage. So let's do that one by one. So in order to get the financial cash flows, notice that what you're given already in the exhibits is the EBIT. This is given. Tax rate is given. So the tax expense is, I believe the tax rate is given in the case as 40%. So what I'm doing here is as follows. I'm saying this is where the firm is in 2001. This is like our year 0. I've taken the EBIT numbers from here and plugged them over here. And then I'm calculating my taxes as 40% of all this EBIT to get my EBIT into 1 minus the tax rate. Okay, so I'm getting all of that. All right, so this is just EBIT into 1 minus the tax rate. For my depreciation figures, fortunately, those are given in the case as well. This is again one of the pieces of the information that is given in the exhibits. So I'm putting that down over here. Now, therefore, my operating cash flow is basically, I'm doing this and then minus this. The reason why I'm minusing some depreciation, because depreciation is already entered as a negative number here. So I'm basically adding it back. So this gives me my operating cash flow. I am given information on CapEx. I'm given information on working capital. Or I basically take all of that, plug it over here, and this gives me my unlevered cash flows. Please ignore the stuff. Please ignore for the time being the stuff that is beyond 2006, right? So if you had to make your forecasts for financial cash flows for up until 2006, this is what you'll do. Any questions up until that? All right. There's a couple of other pieces of information that were given to you in the case. I don't know if this is told over here, but the case actually mentioned that beyond 2006, we are expecting growth rate of 5%. And this is the terminal value growth rate. So now this is the single most important thing that makes this example different from the Tex-Mex case you saw. Because in the Tex-Mex example, you just had data for 4 years and the project was finished. Here, the project is going to go on till 2006 and then beyond. And the rate at which the growth rate of cash flows is given, that's 5%. So now here is what I'm doing. And you will see why I'm doing this later. But I'm not directly calculating terminal value at this point. Rather, I am explicitly calculating my financial cash flow for 2007, 8, and 9 explicitly by taking this guy and multiplying it by 1.05. So 519 is basically this guy multiplied by 1.05. For 2008, my cash flow is whatever it is here times 1.05. 2009, it's this guy multiplied by 1.05. In other words, I'm not calculating my terminal value here. Rather, I am explicitly first forecasting financial cash flows for the next 3 years. And then I'm going to calculate my terminal value here. Why am I stopping here? Again, you'll see why. There's a reason why I'm doing this, and this will become clearer later. But bear with me for a second. Main point, I'm not calculating terminal value at this point, not in 2006. I'm going a little bit further out till 2009. So now, basically, I have my unlevered cash flows. I will need to first calculate my terminal value. Now, how do I get my terminal value here? What do I do? How do I get my terminal value? What do I need?
Just the growth rate and the long run growth rate.
Yeah, so I need my this year cash flow. I'm going to multiply that by 1 plus 5%, which is the 1 plus growth rate. But then I need to do divided by R minus G. Yes, R minus G. But what is R? We haven't really talked about it yet. Since this is the case of all equity valuation, the R will need to be the cost of unlevered equity. Now, fortunately, if you go in Exhibit 3, you'll see that you're given asset beta for other firms which are in the same industry like Kramer.com and CityRetrieve.com. Their beta is 1.5. And this is asset beta. So this is the beta we can assume for Sampa Video as well. And this is precisely the equity beta that would exist if Sampa had no leverage. So basically, you can calculate R naught as equal to the risk-free rate, which is given, plus the asset beta 1.5 multiplied by the market risk premium, which is 7.2, also given. So 15.8%, 0.5158. And this is precisely the unlevered cost of equity that I have over here. And it is precisely that discount rate R naught that I'm using here, right? So J15 is 0.158 minus the growth rate 5%. So this still gives me the terminal value. And so now my unlevered financial cash flows with terminal value is basically all of this stuff. And then my last year cash flow is basically the sum of these two numbers. So main point, this project for Sampa Video is going to yield these unlevered financial cash flows. And value of the unlevered project, therefore, will be equal to, and this is just the value. Value is just what is the cash flows beyond year one. This is very important. This is again very similar to what I did in Tex-Mex. Value is based off of the financial cash flows here. Net present value is basically taking out the initial 1500. So the net present value comes out to 1228.49. Okay, we'll continue from here. Let me take attendance.